If you ever thought about using your super to buy property or reduce your tax bill, this might be the smartest financial move you'll ever make, but only if you set it up the right way. Because here's the truth, SMSFs can give you incredible control, flexibility, and tax advantages. But they also come with risks, hidden costs, and a lot of compliance traps that most people only discover after it's too late. I'm Davie Mach, and I'm not just an accountant who set up SMSFs for dozens of clients. I actually run my own SMSF, and in this video, I'll show you exactly what I've learned from both sides of the table, as an advisor and as an investor. In this deep dive session I had with my clients, I walk through when an SMSF makes sense, when it absolutely doesn't, and how to structure things properly if you're looking to invest in property or build intergenerational wealth without getting smashed at tax time. Let's get right into it. This is SMSFs, but more tailored towards what I'm doing with my situation, so you guys can see the first hand investment journey that I'm going through. So I've just shared my screen, and I just want to show you guys, this is kind of like a structure that a SMSF looks like. So SMSF is actually another type of trust. So you guys would have heard trust many times before in my videos. A trust is basically a entity that's been created for the benefit of the beneficiaries, and the beneficiaries being the owners. In this case, because it's an SMSF, the owners are the members. All right, they are also known as the beneficiaries in a trust. Yep, and the SMSF trades or investors, doesn't really trade because it's hard to run a business in an SMSF. You basically can't do it based on the rules. It's very, very difficult to do it because you got to value the business, you got to value the investments, and it's really difficult to do something like that with an SMSF. So therefore, most SMSFs, majority of them, I'm talking about 99% of them, all have just investments in it rather than running a business in it. There has been talk about someone trying to do property development using SMSF, but in most cases you can't do it because you can't value a property development in the period of it getting developed, and it's so therefore the auditor won't sign off on it. That's one of the reasons. There's other reasons. There are other issues as well, but one of those reasons is they can't get a value on it. And it's very hard to get a loan using a SMSF for property development as well. So you probably have to do all cash. Yep. Okay. So SMSFs can also have a trustee company or trustee. Trustee is just basically the controller of the trust or the SMSF. And we usually recommend doing a trustee company rather than just individual trustees. You can have individual trustees. The individual trustees will be the members. But it's a bit risky doing that because if you do set up everything as individual trustees, if the individual gets sued for any other reason outside of the super, the person suing the individual would do a search on the total assets that the individual owns. And if the individual is a trustee of the SMSF, that means that they may be able to find out that what the SMSF's assets are as well, and they try to go after the SMSF as well. So that's why most of the time it's better to have a separate trustee company that manages it and that holds the assets on behalf of the SMSF rather than having an individual be the trustee. Like some people might save $1,000 for the setup by setting up individual trustees in an SMSF rather than a trustee company. But the result is that it just ends up costing you a lot of money if something bad happens. Yeah, so it's better just to have a trustee company in the first place. Okay, if you're borrowing money, if you're planning to buy property, for example, and you're trying to borrow money, then there might be an option of needing to set up a bare trust. So a bare trust is basically a trust that's set up for a special purpose. And in this case, a super fund, self-managed super fund, written in the SIS Act, which is the superannuation rules, the super fund are not allowed to borrow money. So therefore, you have to set up a trust that borrows on behalf of the SMSF to buy this property. And then once it's paid off, the bare trust transfers the property over to the SMSF. So that's why a bare trust is, they talk about a bare trust a lot. Another word or term for a bare trust is called a custodian trust, I believe is what it's called. So you might hear custodian or bare trust. But the usual name you hear is always bare trust. And you usually hear it when you're speaking to advisors about purchasing a property, or you're borrowing money from the bank and they ask you to set up a bare trust. Yep. Does anyone have any questions about the structure of a SMSF? Nope. Okay, cool. There's also industry super funds. And that's not a self-managed super fund. It's just basically what Australian Super is, what you have in Australian Super, what you have with Host Plus. And basically, it's actually not too bad of having industry super fund. So industry super fund, average super fund fee is like 1.3% to 1.5%, or maybe sometimes even lower. So they charge you based on how much your membership balance is. So I'll quickly go through this because I've shown it before. But basically, if your balance in your in your industry super fund is like 300,000, you'll be charged about 3,700. That's just the average. That if you chuck in the calculator, it will work something out like that. And that's like all fees, not that's like transaction fees, management fees, and admin fees as well that they charge you. They call it all different things, but they end up charging you about 0.5 to 1.5%, and so we just average it out to 1.3%. So if you set up an SMSF, it's going to cost you 2,500, and then ongoing costs will be about anywhere between 2.5 to 4K. You'll see sometimes online vendors that are a bit cheaper, but it's so basic. You're talking about maybe cash in the bank with a self-managed super fund. It will cost you like $1,000 a year. You can get it at 1K a year, but no transactions, just interest income and just money in the bank. And that's where it's like $1,000. So you got to be careful. And also they rely heavily on you and push all the risk on you. So if you make a mistake in the tax return, and they won't change it, they'll make you they'll charge you more every time you change it. So therefore, as a cost, it just ends up ballooning as a result of that too. So I've heard bad situations where people go for those ones that are cheaper, but then ends up costing them more money in the end. Yep. So that's how to do a comparison. So if usually when they're looking at your super balance between two spouses as well. So usually the spouses will add their super fund balances together. So 300K is not exactly just one person. It's like two of them added up together. So therefore they can split the costs as well if they set up an SMSF. Okay, so pros and cons of setting up SMSF is that you get to manage your super fund yourself. That's a pro, but it gives you a lot of flexibility. So you can then start deciding, do I want to invest in property? Do I want to invest in crypto? So all the crypto bros a lot of them set up SMSFs in the last 5 years because they see super as a long-term investment, and they see that if you just hold crypto, it's going to go up. That's what they think. And honestly, they kind of are right now. It's proven that it has gone up if you just hold it long term, even though it goes down really fast, but it goes up as well. So in the long term. So that's what they've done. They've set up SMSFs and held on to it. And then they've just set up SMSF using one of those platforms crypto platforms to be able to purchase it. And there's also really good tax benefits. So these are the pros. Being able to buy property, crypto, giving the flexibility to do anything. So that's the flexibility. And also there's a lot of tax benefits. It's 15% tax. It's probably the cheapest tax you'll ever find in the world, in Australia, not the world, sorry. And if you were to do a comparison, like for example, here, if you got a business, 25% is your tax. SMSF's tax is 15%. Or 0% if you're in pension phase. So if you're over 60, 65, it'll be at 0% tax. Your bucket company is taxed at 30%, and your personal names are taxed at 0, probably anywhere between 16% to 47%. Yeah, so that's really high taxes when you compare the bucket company, business, and personal versus a SMSF. That's why people love using a SMSF. However, there are rules there are cons. Cons is you can't really access the money until you're 60, 65. The money's locked up for your retirement. There's a lot of, because there's flexibility, that means there's regulations, that means there's a commitment that you have to actually self-manage your own super fund and the investments. You have to buy your own investments and all that stuff. But an industry super fund doesn't require that. For smaller balances, the cost actually outweighs the benefit. So, for example, if you're on like $50,000 as a super fund balance, the cost for industry super fund will be like what's $500 to $600, but it's still going to cost you this much if you're on 50K super balance if you set up an SMSF. So it's actually not that worth it for smaller funds. And yeah, obviously there's a bit of risk as well running it, because there's a risk of you messing things up for because it's regulated. There's a risk of you making bad investments, and then you can lose all your investments because you're not good at it. So, and there's obviously a risk of people scamming you as well. So when you set up an SMSF, it's very similar to setting up a trust. What you do is you create a trust deed for the SMSF. You fill out the information. It's very long. Like, you have to provide all the details. You have to set up the members, and then what happens is once that's all set up, you go and register it with the ATO. As long as you have lodged everything up to date in your personal name, and all your related entities and companies have been up to date. So previously, the ATO used to just issue self-managed super funds and approve them straight away. But now they've realized that they want the trustees, like the individual trustee or the company trustees, to be compliant already, to have a history of compliance. So they check the directors to see if the directors' tax returns are up to date. So as long as they've got really good history of lodging tax returns up to date and paying their taxes, they'll issue the SMSF and register it. So back then they didn't care about that, and they just gave everyone the ability to set up an SMSF and approve it. But nowadays, like, the ATO is a bit smarter, and they realize that those people that are normally not compliant in their personal names in their tax returns are probably not going to be compliant with the SMSF. So therefore, we shouldn't give it to them. So there's actually responsibilities that a trustee is supposed to have, like the individual trustee and the company trustee, is that they have to be, they have to know how to manage their funds. They have to also lodge the taxes up to date. That's just some of the rules that they need to follow. So if they see that they're not up to date individually in their personal name, they won't issue the SMSF to them. So that's one thing. Once that's set up, you need to go set up a bank account with the SMSF. So you go to the banks. Some of the banks don't actually allow SMSF setup. So Macquarie, I know for sure, does help you set up an SMSF bank account. Excuse me, sorry. So you can go to Macquarie and go and create something like that. Yep. Once you get a bank account, what you then need to do is then speak to your industry super funds and get them to transfer or roll over your super that you already have with them into your super balance, into your bank account for your self-managed super fund. Once you've done that, it takes about 2 to 3 weeks. Then basically you've got money in the bank for the SMSF. You got the SMSF set up. You need to go and speak to an accountant if you don't have an accountant, or you've already spoken to an accountant. You need to let them know, and they'll set up a software for the SMSF, so you can start doing the reporting properly with the ATO. Because as a SMSF, you need to report to the ATO the contributions that has been received by the employer for the members. Yep. Or by the personal contributions by the members. So you need to set it up properly. It's kind of like single touch payroll, but for super funds. Yeah. I forget the name of it, what it's called. My team does it more. Okay. So that's basically how, in a nutshell, a SMSF is set up. But once it's set up and you're planning to invest, then there's a bit of a more process. You got to set up a bare trust. You got to go and provide the bare trust to the bank. You got to go get a pre-approval. There's a whole bunch of things that you have to do as well when you're purchasing a property with this SMSF. Cool. Any questions so far about setting up SMSF?
Quick question, Dave. Regarding to the rolling over from super fund into the salmon is
Self,
fund, right?
yeah, yeah.
So if you still got the money left over to industry super fund, do we
Mm.
need to report to ATO when to do the tax returns every year?
Or if you haven't transferred it over,
And I haven't transferred all of them. Let's say I have 100K, I only transfer 80K and
yes,
20K left over in the super fund.
yeah.
Uh, do I need to report that to ATO as well, or we don't need?
The $20,000 in the industry super fund. Yes, you do need to report it, but you don't need to do anything because industry super funds report themselves. Yeah, so because it's not self-managed. So self-managed means that you do everything yourself. Industry super funds, they do it for you. They pay the taxes, they report to the ATO, they make sure everything's compliant. Yeah. So you probably leave the 20, just so you know, that's a very good question. People leave money in the SMSF. Sorry, they roll over most of the money into SMSF and they leave like $20,000, $10,000 in the industry super fund. The reason behind this is that uh, he's got insurance or they've got personal insurance like such as life insurance, income protection that they want to keep. Um, just a recommendation. Again, this is just general information. Do your own research. Is that from what I hear from financial planners is that they say that the industry super fund insurance is generally a one size fits all type of insurance. So it's not generally the best insurance for your situation. So it might be a good idea for you to like look over, speak to a financial planner, and just get them to review your insurance policies, just to make sure that it covers, the money that you need, or your family needs if something were to happen to you, or if something were to happen to you and you can't work anymore, it's enough to cover for everything. I had a client that he was an electrician and he had something wrong with his heart and he had an episode at home, and he actually passed away, but he got revived by his I think it was his wife or the ambulance person, and he had to get a pacemaker in his heart, well, in his chest, and after that he couldn't work anymore. But then he did have insurance, but the unfortunate thing is that the insurance in the industry super fund didn't really cover him enough. So therefore, like it was really hard for the family. The wife had to go back to work, and yeah, he basically had to be like a stay at home dad. They managed to make it work, but it would have been easier if they just reviewed the insurance policies to make sure that it's enough. Because whatever you set up, when you set up an industry super fund, like Australian super, I do this too. You kind of just forget about it. You don't ever review it. You don't come back to it on a yearly basis or by every 2 years or 3 years. Because the thing is, when you set it up, your income might be at $100,000 or maybe even $200,000. But your situation in the next 2 to 3 years, 5 years, it changes. Maybe your income might stay the same, but your assets and your liabilities don't too. So you got to make sure that your life insurance and your insurance, your income protection covers for that if something were to happen. So, for example, me as an example is a really good case. 3 4 years ago, I used to pay myself $80,000 a year, and I didn't really have many assets. So my insurance policy covered me for 500K if something were to happen. I went to give some money to my parents and to my partner if as a heartbroken gift if something were to happen to me. But now I've got millions of dollars in loans, and I've got a business that's worth millions of dollars as well. So what happens if I pass away? It means that my wife will take over the business, and she would be heartbroken, and she most likely would not want to keep the business because she can't run it without me. Um, and so she'll probably sell it. When she does sell, she either sells it. Sorry, before I start there, my wife also has a loan, all these loans that the bank will recall now because I'm not. I was the sole bread. Well, my wife worked as well, but because the Davie's the main business and he had the license as well, he's the business owner. Um, the bank would then go to the wife and say, "Hey, you got to sell your house to pay off these loans because we're not going to lend you this money because your income is not enough." and we don't know if you can actually manage the business. So therefore, they'll force her to sell, or they'll question her, and the result would then be she probably would be heartbroken anyway, and she'll be like, let's just sell everything. So she'll just sell at a discount and lose everything, lose a massive amount, and then pay off the loans, and then she'll have the house. But then the problem is you can't split the house between my family members. Like my mom and dad, I wanted to leave something for them. So the house then will be a result of like she wants to live in it, and we're expecting a baby now. So she wants the house for the kid, and my mom and dad and my brothers would probably have a issue with that because they were reliant on me as well. And so therefore I'm just worried about like, infighting and like issues later on down the track. That's why I needed to up my insurance. So if I up my insurance and if something were to happen to me, I could cover for her to keep the business as well as pay out all the loans. So therefore she would have this house and we'll have the business, and then they can probably either sell part of the business or they can keep the business and just live off the business for the time being and sell at a good value rather than just fire sell and rush to sell everything. So yeah, that's why getting a industry super fund insurance and not reviewing it often is something that like you just need to look out for. So get a financial planner, speak to a financial planner so they can assess what you actually need and look at the future as well, what your plans are too, so you can get insurance to cover that as well. Cool. Anyway, that was a side note.
I already set up my SMSF with me and my husband as the trust beneficiary, whatever you call that words. And what we did is we set up that SMSF, but we didn't do any rollover fund from the industry super fund, for example, Australian super to here. We just created and we didn't do any activities for the last 3-4 months. We were in dilemma what to do, how to use these funds. Do we still need to lodge a tax return for that SMSF account for last financial year?
You would still need to lodge something with the ATO, whether it's a nil tax return or a return not necessary. It depends on what you've set up already. If you have money or if you've got a bank account.
We didn't have any money transaction, nothing happened. Just set up bank account were set up, everything was set up, but no money transferred.
Most likely it will be a return not necessary then. You still have to go speak to a tax agent and get them to add you as their client, and then still they have to file something for you. It'll be a lot cheaper though. It won't cost you like $3,000-$4,000, but it will probably be some sort of cost for their time to set to lodge a nil return for you.
And the next question is like, as when you talk about insurance, it is important to have insurance if you're running SMSF, isn't right? Like, you can't leave the SMSF without insurance. Is that something?
You don't need to have insurance. It's up to you.
Okay,
There's no requirement.
If I'm investing in a property or something, if I don't have insurance, it's not an obligation for SMSF.
Well, if you're investing in a property, the banks will request you to have insurance.
Okay.
There's no rule that you need to have insurance for SMSF. It's probably a bad idea if you don't have it, but it's up to you. Like if you don't have anything to insure, like if your income is not high, or if your life is like if you don't have any assets, then it's up to you if you want it to get insurance or not.
And your recommendation is always to have a financial planner when you run the SMSF.
No, I was just saying that you should speak to someone if depending to assess it, and you should also review your insurance policies on a regular basis. So you can still use the industry super fund for their insurance policies. Like most people, like I said, it's like a cookie cutter insurance policy. It's not a bad insurance policy. It's just that it doesn't actually work for you. Like it doesn't work for me because Davie Mach is not the typical person, and he also has a lot of responsibilities as a son and as a husband and as a dad soon. So it's not the typical person that like a cookie cutter insurance policy will work for. So you could just got to review it. Yeah.
Yeah. Thank you.
Yeah. Cool. No problems.
Can I just ask one question?
Yeah, sure. Of course you
can. So just to understand everything. So right now I don't have a self-managed super fund. I just have an industry super fund. My situation is I work full time. I also have a business on the side. So I'm thinking of standing up a self-managed super fund, getting my super amount and my wife's and putting it all together, getting some property. But what I was thinking, and this is where my question is, I was planning still to work full time. So my super contributions as part of my job, can I leave them in my industry super fund? Like if the property that I've got sort of covers itself, and like obviously that depends on what property we buy and everything. But if that is self-sufficient, I don't need to change everything, right? I can still run both at the same time.
I guess it depends what you're buying, because you when you go to the bank to borrow money, right? They can't use your personal income anymore. So when you traditionally go and purchase a property using, again, I'm not a broker. I don't work for the bank, so I don't have any license to give this type of advice. So this is just general advice from what I've done, right? But when you go to the bank to try to borrow using a super fund, it's very different from borrowing in your personal name. In your personal name, you use your wages, you use your income from your business, your side hustle, and you can use the rental income from your property as well. That gets all added up. But if you cut all that out and only have the rental income from the commercial property, how much do you really have to be able to borrow? So residential is 3% rental yield. For those that don't know what a rental yield is, it's basically the whole annual rental income that you receive versus the value of the property. So say you buy a property for 500K. All right, that's really cheap in Sydney, but let's just use that as an example. And you get a rental yield of 3%. That's 15,000 divided by 52. That's like 288 per week. Like, how much can the bank actually lend you on 15K?
If you want to use my actual example, let's like rough calculations. So between my wife and I, we have a bit over 500,000. So I would take all of that, obviously, and use that to purchase a property. I was thinking, these are all rough calculations in my head. I was thinking of buying a property roughly around 700, 750, let's just say, because I was planning on not in major city. Like I was thinking like more rural Queensland or something like that. So
that's a good
based on that, I
Yep.
would think that the loan is only like 250,000, right? So
Yep. Let's do that right now. Keep going.
yeah, I would think it should cover itself, but
Yeah. Okay. So possibly, so like this is going to be a 3% yield. I don't know what the yields are. It just depends on where you're buying. But just say it's on average, you use ChatGPT, it would be say 2 to 3% in Sydney. Interest expense is 7%, and so therefore you got a net cash flow of 5K. I don't know if the bank would lend you based on just your rental yield being this much. What they will do is they will ask for the super contributions to be contributed to the SMSF for the sake of having more income in your SMSF to be able to service the loan. Yeah.
yeah, okay.
Yeah. So my point was that I was trying to get to was that your rental yield is probably going to be too little for them to be able to lend you that amount. Yeah. So
Yeah, I was hoping to be self-sufficient with the self-managed super fund.
But why do you want the contribution to go to the industry super fund, for example?
Just because like hedging, I guess. Like if I guess in 5 years' time, if I'm running a self-managed super fund and I feel comfortable, then most probably I wouldn't. And also my plan is in 5 years' time, I wouldn't work full-time in my job anyway.
Yeah.
Ideally. But yeah, I guess it's comfort level, right?
Yeah. So you're hedging and you're diversifying your investments. So just so you know, SMSF doesn't, when you set up SMSF to purchase a property, the SMSF can also have a bank account that has a that could be registered with a what do you call those, exchange, the platforms and brokerage, and then buy ETFs.
Yeah, okay.
Yeah. So
I could essentially replicate what the industry super fund does.
Yeah. And that's what normally people do. That's why it's called self-manage. Like you manage it yourself. And therefore you don't need to be charged those admin fees of 1% or whatever from the industry super fund. Yeah. So like if you want to do nothing and set and forget, then yeah, all right, leave the money in the industry super fund. But the goal is like your goal is to purchase that property. And you obviously for the first couple of years of having that self-managed super fund want to make sure that it doesn't go into negative. And net cash flow, like being negative. So therefore, you'll probably want to have all the contributions going there for the time being anyway. And there's this new, look, again, I'm not a broker, but there's this new bank that's allowed an offset account in SMSF. So there's an offset account in SMSF which can lower the interest savings on your property. Okay, whether it works or not, it depends on your situation, but it's the first of its kind that's happened in the last 6 months. I've heard of it. I've seen clients starting to set it up. I'm actually trying to set it up myself and see how it goes. Again, it's very new, so we don't know if it's going to completely work, but yeah, having an offset account in the SMSF is game changer because you can just basically put your money into SMSF and save like 6-7% in interest if you're not deploying that money into like a ETF or anything like that, or crypto or whatever it is. You can just have all your contributions sit in an offset account. Cool.
I can put some comment on that because the way I set up SMSF fund, and even I can borrow a lot of money. It depends on how you're gonna buy your property. You can set up the offset account as well. So you can dump your money there, or you can use the money to buy stock or whatever. So and you don't need to even you work full time, right? You don't need to put your super straight back to the super fund. You can go straight into your SMSF super account.
Yeah, so you can do both. You can have contributions to your industry super fund if you want. I still have the industry super fund set up 0% right now because I'm transferring the property in. But yeah, you can, and then you can switch anytime at work.
Yeah, you can roll over, like quarterly or yearly. Something.
Yeah, and sometimes this is what happens actually. So situation is a good one. Like if he runs out of cash in the industry super fund because he hasn't been putting contributions in, he can just do a rollover form in his self-managed super fund and roll over money back from the self-managed into the industry super fund. It's as easy as transferring from a bank account and filling out a form.
Okay, so you can go both ways.
Yeah, you can go both ways. Yeah, doesn't matter. As if a industry super fund is not going to accept your money. They would love to have your money. It's actually the opposite. It's very hard to transfer out.
Keep in mind, when you take money out, they're gonna apply the hassle on you.
Yeah, it takes like weeks to get the money out when it should really take a day or two. But if you transfer money in, it takes literally 1 day. It's in the bank account, in your member balance. It's crazy. Well, and they're actually getting flamed for doing that. Sorry, any more questions before I go into more specifics? No? Cool. All right.
Maybe I got one actually.
Yes, sure.
For the SMSF, if you're buying a residential or commercial property, does the individual borrowing capacity taken into account? As you know, right?
Yeah. Sorry, did you say? Sorry, I didn't get the question. I just heard that you're.
Yeah. Would the individual borrowing capacity be taken into account?
Oh, as in your so. The answer is no. They won't take up your personal income, but they'll take up your contributions. So they'll look at your contributions of what you've been putting in the last 2 years, and then base that on those contributions. They will look as if those contributions will continue to stay as well. So for example, if you lost a job, then most likely your employer contributions won't be there. Yeah. So yes and no is the answer then, because it depends on if you can. The main thing is, can you actually contribute money? So they look at your 12% contributions if you're an employee. And if you're a business owner and you're just manually contributing personally, then they'll just look at your last 2 years if you've contributed money and take the average. Okay, that's just like a big assumption. All banks have different policies, but that's just roughly how it works. Yeah, and then obviously they'll add in the SMSF's ability to bring in cash, which is rental income or investment income as well. Remember, SMSF, it's funny how people say that like it's usually like this way where it's individual and the individuals are like spouses. But I've seen SMSFs with like business partners as well, where there's like 4 people and it's like business partner 1 and spouse and business partner 2 spouse as well, just so you know. So you guys can combine if you got you can combine it into a bigger balance and buy it like the business. Cool. So I just want to quickly show you guys my example of what's happening with me and what my goals are. So you guys can have like a bit of like a understanding of how to use SMSF and what you can do better. There are like certain rules. I'm going to quickly flash through this like real quickly. So I've obviously just got a bit of rules here that you need to follow. like I said, SMSFs have like strict regulations and rules that you have to follow. Sole purpose test, like basically the whole purpose of the trust or the SMSF you're setting up is for your retirement. That's what it's supposed to be for. It's not for you to buy your home, live in it, because there have been cases where people try to do something like that. You can't do that. You're not allowed. It's not used to lend money to your business. And I've seen things like that before. You're not allowed to do those because the whole purpose is for your retirement, not for you to do other things and lend money to your own business. Like it's a trust format with individuals. You can have up to 6 as members. The trustees are personal liable, so the ATO will penalize the trustees if they do something wrong. That's why they really check the compliance history of the trustees now. Investment strategy needs to be written every single year. No loans or investments can be given to the members, but the other way around can work. So if you lend money to the SMSF for an investment, it could possibly work, but it has to be there's strict rules on that. Also, related party rules. You can't be purchasing a residential property off yourself. There are rules where you can buy assets, which is if you buy a commercial property from yourself, from your business, or from yourself, and you lease to your business a commercial property, which is my case. You can buy ASX listed shares, you can buy ETFs, you can invest in crypto, as long as you follow the rules. There are strict rules about valuations of the market value. Transactions must be a market value and has to be well documented. So, for example, if you buy shares in, a company called X, Y, and Z that was set up by your uncle or your brother or your sister, how do you value that business? So that's the problem with SMSFs, that you can't easily buy privately owned companies because you need to do a well-documented valuation of the business on a regular basis, and the auditor may not accept a piece of paper or a balance sheet or a profit and loss on zero that proves the value of the business. So that's why people usually generally buy ASX listed companies or commercial properties, because you can actually find the value of those properties and assets rather than a privately owned company or business. Okay, no in-house assets over 5%. That's just you can't have related party investments of more than 5%. That's also a way where you can't buy your own business in it. Yep, and then loans. You can't have too many loans to you can't have really loans to related parties. It's really hard to do that as well. Cool. So those are the rules. I won't go into specifics because you can do that when you speak to me as an accountant, when you're setting up a SMSF, or speak to your current accountant. And for your case, Priya. But yeah, all right. So individuals this is my situation. Got husband and wife, set up an SMSF, and I've got a business, and I've also got a family trust and a bucket company. So what my goal in the future is, I want to stop working for the dollar once I turn 40. All right, that's in 5 years' time. So what does that mean? That means that I want my businesses and my passive investments to make money for me, that it's enough for my spending. So therefore, I don't need to always continuously think about working if I don't want to work anymore. My goal is to continue to be an accountant because I love being an accountant. It's really fun for me. But I just want my investments to look after my family, so I don't have to have the burden of thinking about money as an immigrant, as an immigrant family. Because I just feel like money is just is evil sometimes when you think about it too much. It just causes a lot of heartaches and friendship breakups and all that stuff like that. So my goal is then is to have a bucket company that has investments in there, and this is a medium-term investment. So we're talking about anywhere at the time of 40 to 60 years old. That's where most of my medium-term investments are going to sit here. If I need to take the money out, I can liquidate the assets, pay the 30% tax, and then take the money out into my personal names and pay anywhere between 16 cents in a dollar to 47 cents in a dollar. I will try to keep my tax rates at 30%. And the reason being is because that's a better tax rate to be on because it's the same tax rate as the company. So I just opened up a spreadsheet, an Excel document. And if you look at the tax rates in Australia, and then look at here and scroll down, the tax rates in Australia is that if I want to stay at about the 30 cents tax rate, I want to be at 135,000. If I want to stay at the 30 cents. If I'm happy to pay a bit of a top-up tax of the tax that's already paid of 30% in the bucket company, then I can pay up to 190K. Yep. So what I would do is like me and my wife are still taking wages from the business, right? And the wages are really pushing us to like the highest tax bracket, basically. But eventually, me and my wife might work part-time or work less or take less of a wage. And then as a result, we could be on some income like this, or maybe even zero. And then what will result to is that this bucket company will have a lot of cash because of retained profits, because I'm investing using it. And during the ages of 40 to 60, I will be declaring dividends to myself. And the tax has already been paid of 30%. So there's something called a fully franked dividend that you can receive. And that fully franked dividend is just the ATO's way of saying, hey, you've already paid 30% tax on your income, on your retained profits. So the money that you transfer over to yourself as a dividend now through the trust can be, there's a tax credit of 30% already. So if you don't make over a certain amount, say you make only like $60,000 from those dividends, the tax already paid of 30%, you might get a refund. You might actually get a tax refund because the tax has already been paid and you get a tax credit for it. So that's what me and my wife would do when we're 40 to 60 is to, 35 to 40, our goal is to make as much money as we can, set up our investments in the bucket company, and for the medium term. And for the long term, we'll also be contributing money from the business to the SMSF and our wages to the SMSF, and then try to maximize $30,000 contributions. You know, the concessional contributions. You guys probably heard of it all. So basically, me and my wife can put in basically $30,000 each. So really, that's like about $60,000. It's a lot, but it's capped if, you know, say I'm making 500K plus in profits. I could actually put more, but I'm just not allowed to. So what you could do is use non-concessional super to do that, but you don't get a tax deduction for it. Or you can rig the system. It's not really rigging the system, but you can actually get a SMSF commercial property in here, and which you can charge rent. So what I've done is, because I run an accounting business and I've got an office, a lot of doctors do this. They buy their medical practice and they move the medical practice into the SMSF, and then they rent to themselves. And when they do that, that means that rental income from the business also gets to be added into the SMSF, and it maximizes the money that gets received. So your income is not 60K anymore. It could be that plus the net rental profits that you're making. And that's where it could be like an extra $20,000, $30,000 if you pay off your loan. Yeah, so then you can be getting on an annual basis like 100K, about 100,000 or more into your SMSF on an annual basis until you reach 60, and it might balloon over to like millions of dollars. And that's where, when you're 60, you can then turn your super fund into retirement phase, and then you can just pretty much stop working and pay yourself a pension between you and your partner from the SMSF, which is then taxed at 0%. And then you pay yourself dividends from the bucket company when you're 60 as well, if you want to, and just keep the income as low as possible. Keep the dividends like, 45K each or 60K each, and you'll get a tax credit, a tax refund, because you'll have a tax credit of 30%. And that's my way of setting up my SMSF and my retirement for the next 20 years, basically. I'll live off like how that works. But the first goal is consolidation, investing, and getting enough cash to invest. Because right now, the biggest issue of myself and my wife is that we're working for the dollar and we're trading our hours, our expertise for the income to support our lifestyle. But eventually, assets can do that for us. And that's why having a bucket company and SMSF is a good idea. A lot of people don't get the right advice and they do everything in their personal names because they can borrow more in their personal names. They've got the income in their personal names. It's all great. But the problem is that if you've got everything in your personal name, what do you think your tax rate's going to be? It's 47%. So your 47 being 45 plus the 2% Medicare. So that means that every dollar that you make, you're kind of like sitting at a handicap. You know how like you're too good at making money. So the government then just goes, all right, we'll take 40%, we'll take nearly 50% off the income you make. You invest with the other 50%, which is going to slow down your growth. Whereas if you were to invest using a bucket company and an SMSF, they can't take the 47%. They only can take 30 to 15%. So the compound growth from that alone, just by saving on taxes, can help you get to your goal of retiring earlier, faster. Yeah, so that's my structure and my goal of what I want to do. Okay, cool. So how does it work? How am I going to do this? Is the next question. First things first is like I'll set up SMSF, which is already I've done, and then I'll just start contributing money into the SMSF. I won't even need to set up an SMSF. I'll have an industry super fund at the start, and I'll start contributing as much money as I can. Because the first step is not to set up SMSF. The first step is to actually have enough cash in your super fund to make it worth setting up SMSF in the first place. So remember, the balance is roughly around here. Like it could be more, could be less, just depending on what you're trying to do. But you want your super balance to be up to a certain point for it to be worth setting something up. So you don't do that yet. You have an industry super fund. Then the next step after that is generate enough income in your personal names. You have to actually make money. Like if you don't have money to invest, then the first step is to invest in yourself. Like do what you're doing. Most of the guys here, you guys know what you're doing and you guys are making good money. So that's great. So you guys already probably passed that phase. But if you haven't, then that's the first focus for you guys. Then the next step is set up an SMSF. Once you set up an SMSF, you can actually still keep the contributions going using your business and contribute more money into SMSF and then start looking at investments into the SMSF. What I do next is you can purchase a commercial property using SMSF or have the commercial property in my situation in my personal name or outside of the SMSF. So 2 years ago, this office came up for sale, but my super balances were like 100K and there was no way I was able to buy a $1.3 million property using my super fund, even if I combined with my wife. My wife and me were not married at that time, so it was a bit weird if I go and set up a self-managed super fund with her as well. So we didn't really have like an ability to be able to do to purchase the SMSF, a commercial property using the SMSF. But I still bought the commercial property because my income in my personal name could fund it. So sometimes, depending on your situation, you might buy the property personally first and then transfer it into the SMSF. I know what a lot of people are going to say, but then you paid stamp duty twice because when you transfer it over from from your personal name to a self-managed super fund, you pay stamp duty twice. And I said, yes, I do. Depends. You can get away with it. There is ways to do it. You just got to structure it well where you can actually only need to pay stamp duty once. Got to get a good lawyer, got a good use accountant. But say you do pay the stamp duty twice, I still think it's worth it. And I'll tell you guys why. Because if you purchase, let's just say that if at that time you purchased a property for 1.3 mil, like say 3 years ago, and then you got it for 1.3 mil, and then you like for my case, I actually rented it off myself because this is a commercial property where it was my office. So I felt that it was really useful for me to have this property, and it was literally next door to my current place. So I didn't have to like move that much. My clients still knew where I was, and it was just easy. So I just said, these properties aren't going to come up for sale that often. I might have to wait another 5 years for this to happen. And by that time, this 1.3 mil might not be worth 1.3. It might be worth like $3 million. And it might be harder for me to buy that property. It might be worth 2 mil, whatever it is. But it's just harder to buy that property with my SMSF. So I just need to act as quick as possible. So I just took in the chin and just bought it in my personal name rather than my SMSF. And knowing that I might have to pay stamp duty twice. Okay, and then what I did is the next couple years after, the next 3 years, I beefed up my SMSF. I contributed as much money as I can in there. If I had excess cash, I'll do a non-concessional contribution. And then I've married my wife as well. And then I combined my SMSF with my wife, and we have a balance of 500K. Now, 500K, I need to borrow, and I'm going to borrow, say, 800K. Oh, sorry, 900K to be safe. And I'm borrowing at 35%, 65% LVR, and that will allow me to borrow it. And the total value of the property has gone up a bit, so it's 1.4 mil. So now it's been 3 years. I got an external valuation on the property, and it's 1.4 mil. Do I think it's worth 1.4 mil? That's another question. I actually don't think it is. I think it's more, but that's what the market value is. That's what the experts have said. So I've left it as that. So what I did now is that because I contributed so much money into my super to get it up to 500. Remember, I only had like $200,000 combined with my wife at that 3 years ago, but I managed to put 500K in. And by doing that, I actually saved in taxes by where is that thing? By here it is, I think it is, by contributing from my business to here. So the tax on there would be like about 15%, whereas the tax would have been 25% or 47% in our names. So I was actually saving a lot of taxes by doing that, by putting the money into SMSF. And then what I'm going to do now is I'm going to take that money out. And how I'm going to do that is I'm going to get the SMSF to buy the commercial property off me. And so therefore I can release this cash plus this back to my personal name. So yes, I put money into my SMSF in this case, like from this business over to the SMSF, and consolidate all my cash there. And my business was I've drained some of my cash from my business in my personal name. But now, 3-4 years later, I'm actually transferring $1.4 million back into my personal name. Yes, I've got a loan on this 1.3 mil. It's about like 1 mil, but I get to then pay off that loan, and then I still have 400K in my personal name, because 1.4 minus the loan on this loan of 1 mil is 400K. So I've got now 400K in cash. Yes, I got to pay taxes. There are small business CGT concessions to minimize the tax. I can actually get that to very close to zero if I do it right. So I can keep all that 400K. So basically, for the last 3 years, I've been contributing money into this SMSF, but now I'm taking it all back out, and I'm swapping my commercial property into my SMSF. Now, the great thing about this now is that I can charge rent to myself at market rent, and it's actually market rent is like about 80 to 90K, and the interest on the loan is 900. The interest is 7%, 63,000. I've got a net cash flow from rental income of $21,000. Then I've also still continued to put more super contributions in, and now my SMSF is beefed up to every single year, making $81,000. And if I do that for 10 years, this is just gonna balloon to 800 plus the growth in the property. It's not gonna be worth 1.4. Plus, if I get all this disposable cash, what do you think I'm gonna do with it? I'm gonna do what Luca's thinking of doing, is diversify, invest in ETFs, and try to make a better return on my investments. And I've also got 400K sitting in my bank account now personally to deploy at buying more investment properties, or reinvest back into this bucket company to buy a second property. Yeah. So that's what my strategy is. And I can tell you guys this because I'm doing it for myself. I'm not telling you guys to do exactly what I'm doing, but it's just a strategy of me playing with my numbers, because I just know how the system works. minimizing my tax, because if I took that money out and invested in my personal name, which is what most people do, is they will pay 47% tax, not 30. And then they will be handicapped on what assets they can purchase. But instead, what I did is I bought that asset with the goal of moving that asset into a SMSF, then paid myself, transferred that property into the SMSF, then took out back all the cash, invested it back into the bucket company, and then invest with my bucket company at 30% tax rate rather than my personal name. And now I've got my business that's making good cash, transferring the money into SMSF, not at 60,000 because it's locked at it's capped at 60, but now I can actually transfer more because I'm transferring 84,000 plus the 60K, so like $144,000 from my business into the SMSF every single year. Yes, there's interest, yes, there's expenses, but still my business is making a net cash flow of $81,000 every single year compared to 60K if I had industry super fund. Yeah, so very powerful.
Just confirming, this will only work if it's a commercial property, not a investment property that I rented out. I can't really sell it back to the self-managed super fund. Is that correct?
Investment property being real
A private residential.
Yeah, residential. Yes, it won't work. You can't. So there's a rule where you can't buy off your personal, the in-house assets.
Yep. Okay.
So, but then because this is a commercial property, it's like not, for some weird reasons, it's excluded. It's weird. So that's why there's a loophole for me. So what generally people do is they buy a commercial property instead. But commercial properties are usually a lot more enticing in SMSFs. And the reason being is because there's two reasons. One is with SMSFs, you can't have a good, strong LVR anyway. Like it's always 60 to 70%. So therefore, you're paying less. You're not borrowing as much. So therefore, your interest expense is less. And so your rent generally is positively geared. Sometimes, yeah. So that's like, and the rental yield is higher in a commercial property as well.
Yes.
Yeah.
Okay. Perfect. Thank you.
Yep. That's why most people don't like buying residential properties in the SMSF. It's actually, but it's also still good because the great thing about buying residential property, and again, I'm not an expert and I'm not a really amazing investor, but people say that residential properties, the growth in the value, the price, it rises really quick compared to a commercial property. Yeah. And the reason being behind it is because the banks value the properties a lot higher because it trades hands faster compared to commercial property. So therefore, in commercial property, it may be worth 1.4 mil in the eyes of the bank and everyone, but that's because nothing's been sold in the last 5 years. That's why it's worth 1.4, because they just think, oh, inflation or whatever. But once a property gets sold, commercial property in Parramatta, for example, that's similar to my property in say in the next 2 to 3 years, it might not be 1.4, it might be $2 million because there's just not many sales for them to target it at. Yeah, so that's why the value of the property has gone, like, it doesn't grow as fast, but technically maybe it's actually worth a lot more with commercial property. Cool. Any other questions, guys? No? That's good, because if it isn't, then I'm going to call it a day because we're up for time, I think it was. Yeah. So this is just basically a general strategy. Like, I just want to show you guys what you guys can do with SMSFs. A lot of people think SMSF or super funds, wait till you're 60, retire, take the money out, that's it. But there is actually a lot of strategy that you can utilize with this. There's other strategies as well. That's just my strategy. But I think the strategies that other people have done, other accountants as well, that some of my friends love it in some other ways. So let me just bring this over to you. These are my notes. But property investment is one of them. And that's the one I went through. Borrowing money using SMSF, so you can use your borrowing power to extend your growth. Obviously, it's risky. The 15% tax rate is amazing as well. So you can actually use, one of my accounting friends call it franking credits arbitrage, which is basically the franking credits are at 30% tax. So if you buy shares in in listed companies that are known to give you like a lot of franking credits, frank dividends, that means that every dollar that you're receiving from those frank dividends is already taxed at 30%. It's fully franked. So the SMSF has a tax rate of 15%. So basically, you're always getting refunds because there's a fully franked dividend of 30% into the SMSF. Your SMSFs is supposed to pay 15% in tax rate. So therefore, you're actually overpaid taxes in the SMSF for your concessional income. Concessional contributions. So you contribute $60,000 every year. Then you use that $60,000 to buy dividends that give you fully franked dividends of 30%. And then you can use that 30% to offset the 15% tax rate. Yeah, that's what some of the accountants do. I think it's cool, but I like leverage more. Like you can actually grow your SMSFs a lot more using that. What else is there? They wait for tax free. So yeah, once you turn 60, the tax rate goes from 15% to 0%. And then that's where like you're not printing money, but you get to take the money out and use it and not get taxed on it. Yeah, you can also like lease to yourself, which is a pretty cool thing that you can do, but only for commercial properties and businesses, which is kind of like what I do. So there's different strategies you can apply. It just depends on you. And you don't need to have a business that you can rent to yourself. You can just have a residential commercial property in your SMSF and you set and forget as well. Cool. That's it, guys.
Davie, just a quick one. If I buy residential property in the SMSF, when I retire, can I move in or still it's off limit?
That's a good question. My answer, I think, is no. You can't do that. You can't move in at all. Yeah, no, the answer is no. Yeah, definitely 100%. You can't move in. But you can just sell the property to yourself.
Oh, yeah, would it be tax-free?
Yeah.
Because,
you retired.
Yep. Okay. So really, once you retire, everything you sell or whatever you take out of a SMSF is tax-free.
And sorry, I'm just thinking like it would be pretty cool if you sold it to yourself and that's going to be your home and that's the only home you have.
That's my thinking. So buy a house that you want to live in the future, and then sell it to yourself or move in. I thought you can move in, but sell it to yourself and then just move in there.
Yeah, usually people downsize and then but the smart ones upsize, because once you upsize and you sell everything and you buy the asset to live in, your home is exempt from the means test for Centrelink. So then they get on the pension. I've heard people do this where they sell everything and buy upsize, and then their home gets exempt from the means test for the pension, and then they get on the age pension, which is freaking insane. Yeah,
it doesn't have to upsize. I mean, you could buy like a coastal, nice small little property that you want to live, after you retire, and then just move in afterwards. But in the meantime, rent it out as Airbnb or whatever. That might be a way to do things. So
yeah, of course, yes, because it takes time to slowly sell everything off as well. Yeah, and then you can gift your money to like your kids as well, and then that means that now, and that's a good thing to do because it's tax free when you're gifting it to your kids, as long as you're over 60 and the super fund has all the assets and it's tax free for doing that. And then you pass it over to them earlier. Then you have your own asset. You live off the age pension at your home, and then you live off the age pension, and then you've already passed your will over to them, and you don't have to worry about infighting, your kids fighting about things, and your kids are set up. That's a very good idea.
So I actually had a question about that, because that was my plan with my self-managed super fund. If I got a property, I wanted to be in inheritance to my daughter. So how would I do that? Once I turn 60, I can just give it to her? Well, that's it, finished?
Well, you can sell the asset in your SMSF. Okay, again, this is like, how long is that? 20, 30 years later? The rules will change, yeah. So, yeah, they're already trying to change the rules like now with that $3 million tax thing. Anyway, not many people that are rich anyway in SMSF, so it's okay. The crypto guys are, but not everyone. In your situation, you'll most likely get tax advice, but my advice would be, if that's a hypothetical situation, is to most likely sell that asset. You can sell it to your not sure if you can sell it to yourself, but you have to sell that asset. Take the cash, it's tax-free, and then give that money over to your kid instead, and then they can go and purchase the asset. Because yeah, it's better doing that. Like if you give cash, it's tax-free in Australia. It's weird. So if you get it into liquid form and gift it to them, and you just hand them you obviously bank transfer it, but you can hand them cash if you want. But yeah, it will be completely tax-free.
Suitcase.
Yeah, suitcase will be nice too. Yes, yeah, that's the better way of doing things. Okay, guys, I gotta run, so I'll see you guys later. Thank you so much for everything, guys.